A business may be making a profit, but is it performing well? Today, we'll calculate and interpret gross profit margin, operating profit margin, and ROCE. It's calculation time. Profitability, a relative measure of a business's ability to make profit from sales or capital investment. We are going to look at 3 profitability ratios: gross profit margin, operating profit margin, and return on capital employed, also known as ROCE. Let's start with gross profit margin. Here is its formula: gross profit divided by revenue times 100. Now we would normally need information from an income statement in order to calculate our gross profit margin. From the income statement, we will need the revenue, the cost of sales, and that will give us the gross profit, the difference between the two. Question time. Calculate the gross profit margin for the year ended 30 April 2012. This is for 2 marks. Here they give us a table with information that we're going to need: the sales, cost of sales, gross profit, overheads, net profit. They also tell us that the gross profit margin was 40% in 2011. Here's our formula again. Let's plug it in. Gross profit is 150,000 and our sales is 450,000. 150,000 divided by 450,000 times 100 gives us 33.3%. Gross profit divided by our sales or our revenue. Sales and revenue are the same thing. Comparison time. So in 2011, they told us that the gross profit margin was 40%. And now in 2012, we calculated it as 33.3%. This means, unfortunately, there has been a decrease in the gross profit margin. How can we improve this? Well, we could try and increase our sales, or we could try and decrease the cost of sales. So how could we increase sales? Well, we could start by changing prices. If the PED value, the price elasticity of demand, is very elastic, what a business would normally do is decrease their prices in order to increase total revenue. Or if the business has a PED value that's very inelastic, then they tend to increase the prices in order to increase total revenue, or change their marketing strategy to increase sales. Now, if we had to decrease the cost of sales, how could we do this? By finding the most cost-effective suppliers, for example, looking at bulk discount deals. Secondly, they could look at improving the production efficiency of the business, if they specifically in manufacturing, for example. Thirdly, they could look at improved inventory management, so not keeping too much inventory or too little inventory. Operating profit margin. We'll take operating profit divided by revenue times 100. Now again, we will need information from an income statement in order to calculate operating profit margin. Here we're concerned with the gross profit, the overhead expenses, and that will give us the operating profit if I take gross profit minus overhead expenses. What kind of overheads does a business have? Salaries, marketing, rent, electricity and water, internet. Those are just a few. Now I just want to look at the difference between operating profit margin and net profit margin. Operating profit margin, we look at the operating profit. That's profit before interest and taxes. And net profit margin has its own formula. It's the net profit divided by revenue times 100. It's not operating profit divided by revenue. This is the net profit. Here we will use the profit for the year. Profit after interest and taxes is used in calculating net profit margin. Question time. Calculate the operating profit margin for 2014. They give us the financial information. Let's start with the formula. Let's plug the values in. We are given the operating profit of 90 million. We are given the revenue as 600 million. Operating profit margin is my operating profit divided by my sales or my revenue. So that's 90 divided by 600 million times 100, and that gives me 15%. Comparison time. So in 2013, the operating profit margin was 12%. That was given in the table. And in 2014, it is 15%. So that's an improvement. So we're very happy about that. We don't want the percentages of our ratios to decrease. We want it to increase. Even though we're happy with that improvement of operating profit margin from 12 to 15%, how could we further increase it? Well, we could look at increasing our sales. We could look at decreasing the cost of sales, which is what we would use to increase the gross profit margin as well. Or we could also look at decreasing expenses. Decreasing expenses is only when we're trying to improve the operating profit margin, not the gross profit margin, because in gross profit, we don't deduct overheads. Return on capital employed, or ROCE, operating profit divided by capital employed times 100. Now, capital employed has its own formula. It is non-current liabilities plus shareholders' equity. To calculate ROCE, we are going to need information from the statement of financial position, or also known as the balance sheet. We are going to need the section of equity and liabilities. Here we are going to use the capital, the retained earnings, which is part of owner's equity, plus long-term loans or non-current liabilities, not current liabilities such as trade payables or other payables, only non-current liabilities or long-term finance. Question time. Calculate the return on capital employed ROCE for 2014. Here is our table again with the information we're going to need. Here's the formula again for ROCE. Let's plug it in. So they give us the operating profit of 90 million and they give us the capital employed of 750 million. So the ROCE is 90 million divided by 750 million times 100, which gives us 12%. Operating profit divided by our capital employed times 100. Comparison time. Now in 2013, the ROCE was 10%. That was in that table. And it has improved in 2014 to 12%. So we are happy. So how could we improve it even further? Well, we could increase our profit, which will affect the operating profit part of the formula, or we could reduce our long-term loans, which will affect the non-current liability side of the formula, or we could use our assets more efficiently. If you liked these notes or these PowerPoint presentations that I used in my video, they are available for download if you sign up to my community. It is a free community. YouTube believes you'd like this other video. Be sure to check it out as well. See you in the next one. Bye-bye.